Good evening, friends, and welcome to this webinar on the updates of the changes in the new equity mutual fund model portfolio. And I am Pratik Jain, and I head the products for the digital wealth business of Anand Rathi. And today we have Shweta Rajani. She is the associate director of Anand Rathi Wealth, and it's basically Shweta and her team who actually does the research and comes out with the model portfolio. Shweta has been doing this, I think so, right from the start, since 2013, when we have the model portfolio on mutual funds. I think so, Shweta has been there and she's been through the entire journey. So I think so, we can have anyone better on this topic to actually explain us how this mutual fund portfolio is created. So we welcome you, Shweta, and basically Shweta would take us through the entire selection process. What are the changes which have happened in this year, and why those changes. So that is something which Shweta would cover, and then I will cover the operational part, how this will be executed. Any questions, partners, you have, you can put it in the Q&A box. We will try to take it in between, or we'll take it once we are through with the selection process. So on that note, over to you, Shweta. We can start with the selection. I'll share the screen for you so that you can go ahead, and thanks for doing this call for us, Shweta.
Sure. Thank you. Thank you so much, everyone, for logging in. Good evening. We'll just take you all through the process. Basically, some of you who've been associated with us for so many years would know by now that every year we go back to the drawing board, we incorporate whatever learnings we've had in the new selection. It takes us around 2 to 3 months, and post that we come up with the model portfolio, which generally continues for the next 12-15 months. So this year again, we did that entire exercise. This time around, actually, we've not made too many changes. Like, you will see in the presentation ahead that we've not tweaked the market cap allocation. There were one or two schemes where we felt, some change was required. So that's the only change we've made. But yeah, let's go ahead.
Yes.
So, just to give a context to all clients and all partners here, what we try and strive for is most of our clients target around 15% return on their portfolios, with risk objective to be at around 40-45% lower risk than that of Nifty 50, which means an alpha, as we call it, a risk adjusted Jensen alpha of 5.5%. To do that, what we do, the most optimal strategy according to us is to have 65% invested in equity funds, 35 in structures, also have a 20% leverage, which could get invested in the structure. If you follow the strategy, then like you can see the math out there, the 65% of the money that's going into equity funds has to deliver around 14% per annum return. For this 14% to come in, now this is long only equity investing in markets, so there's huge dependence on how the market performs. Given this, our assumption is Nifty 50 could deliver 11% out of this 14. Where does that 11% assumption come in? It's mainly if we see how the economy is expected to grow, whether it's RBI forecast, IMF, World Bank, Anand Rathi own forecast. We think the nominal GDP for India could grow in the range of around 9 to 10%. Historically, we've seen there's a very strong correlation between how the economy grows and how Nifty 50 performs over 5-year plus periods. So if you take that strong correlation and the expectation of economy growing at around 9-10%, 11% requirement from Nifty looks like a reasonable expectation. And if Nifty is likely to give you 11%, then what I need from funds is around 3%. And that's how our benchmark becomes Nifty 50. And what we try as an objective is to have a basket of funds which could deliver 3 to 4% more than what the Nifty 50 could deliver. That's what you'll see in this and the next slide as what we've stated our objective to be. Now, one clarification I want to give on this objective is that, when you say a 3 to 4% outperformance, investors expect each and every scheme to deliver that 3-4%. but that expectation, I would say, is not right. And in fact, we've given data in this slide, like you can see, of how at an industry level, if I see from 2001 till today, every year there would be some portion of the funds that underperform Nifty 50. Average has been 33%, which means 1/3 of the universe underperforms Nifty. If I go with that logic, I'm basically saying from 14 funds, we would end up with 4-5 underperformers. But that's not the case, because there is a selection process in place, and we try to bring that 33% down to 15-16%, which still means that we may end up with 2-3 underperformers. However, in spite of those underperformers, our expectation is that the entire basket can have a 3-4% outperformance, but don't expect every scheme to have that outperformance. And while we talk about this 3-4%, historically, how we've also performed, if I show our own, track record, there've been good years, there've been bad years. It's not that every year it's been a static 3%. Equity markets are not linear. But if anyone who stayed invested with us for long times would have seen that a 4% odd performance has been there. Going forward, we think this is a possibility because every year we keep improvising. We incorporate all the learnings of that year into the selection process. So the probability of achieving this 3-4% outperformance only, goes up for us. So where does this outperformance come from? And what are the decisions that we take when we are creating a fund basket? There are actually 3 sources for us. The first one is the market cap decision. Very simply, how much of money should get invested into large cap, mid cap, small cap. It's important because every segment has a different risk return profile. So we do look at some inputs, like what's the earnings expectation, where do we stand from a valuation standpoint, liquidity support, and finally decide our allocations. Like I mentioned earlier, this year, we are keeping our large cap at 55, mid cap 23, small cap 22. This is same as what it was last time. So we did relook, we did go through the entire evaluation. The outcome was last year's allocation can be maintained. The second source for us is what categories do you invest in? Because clearly, if you look at the historical performance, there would be some categories which do better than the others. So having an optimal category mix also adds to this alpha generation. For us, the outcome has been we've eliminated 4 out of the 15 equity-oriented SEBI categories. And finally, it comes down to scheme selection, where you have multiple choices of schemes available in every category. We do our set of quantitative and qualitative evaluation there to see which amongst those various options could be the most suitable one from a forward-looking approach, and come up with the final 14 funds for the model portfolio. Now, coming to what do we do when it comes to market cap allocation and what really is market cap allocation. I'm sure most of you would know, what the SEBI definition is. SEBI says the top 100 companies are large, next 150 is mid, everything below that is small. We've just broken up the small cap into the top 250 small caps and the rest small cap companies. Like I said, it's important to get the optimal mix because each segment would have a different earnings potential, would be sitting at different valuation levels. And we want to get a blend of reasonable valuation, but a high earnings potential for the basket that we are selecting. These are SEBI definitions, and let me highlight here that mutual funds are supposed to follow the SEBI guidelines. So if I am a large cap fund, 80% has to be in these top 100 companies. If I'm a mid cap fund, minimum 65% has to be in the 150 mid cap companies specified by SEBI. These companies, or this universe of 150 companies, could be different than the Nifty mid cap 150 universe. And as of June, when the latest SEBI list came in, or the AMFI list, AMFI publishes it, that list came in. if I look at mid-cap companies, there would be approximately 13 to 14 percentage of Nifty mid-cap 100, which would be different. If I talk about in number terms, if I see what are the companies which are different, there are 26 out of 150 companies which differ. If I talk about small cap, there are 61 out of those 250 small cap companies which are different between the NSE small cap universe and the SEBI small cap 250 universe. So I can't refer to the Nifty index to understand what the earnings potential is looking like, because funds would invest according to the SEBI universe. Because there is no index which exactly replicates the SEBI universe, we went ahead and we created these indices starting from 2018, which exactly mirrors the SEBI definition. We call them as AR large 100, AR mid 150, and AR small 250. We next checked what was the earnings expectation for FY26 and 27, because the portfolio is coming mid-year. It's most likely going to continue till December 26. So the earnings potential for each of these segments for the next 2 years, and like you can see the numbers there, it's showing that mid and small cap could have a significantly higher earnings than large cap. If this has to translate into price growth, it means having a meaningful allocation to mid-small could add that kicker to the return. But valuation is important because we want to see how much of this forward earnings is already priced in today in the valuations, which is where the valuation data. We do a froth computation. Basically, froth is nothing but trying to see what the fair value of the market is versus where I am currently trading. Like if I put it for Nifty 50, when we did this check, fair value of Nifty was around 24,500. The Nifty value at that point of time was 24,700. It showed a 1% froth. If I look at today's levels, it would be at around 2.2% froth. And that was across the segment. If you see, froth was in that range of 1 to 2%, 4% for mid cap. I want all this as overstretched valuations. If my froth was more than 10%, I would say overstretched. Please stagger your investments for maybe 10, 12 months. But in this range, this is pretty much a fair value zone. Also means that a higher probability that the earnings, if it comes in, a lot of it would get translated also into price growth for us. So that's where, if I look at a combination of earnings and valuation, it both suggested a meaningful allocation to mid-small should be there in portfolios. Third check we do is the relative risk. And here the perception is mid and small cap is risky, which is true if you're holding it on for short term. Like you can see the 1 year data here, the beta is more than 1 for mid-small. But as your time period goes up, 2 years, 3 years, 4 years, the beta is marginally lower than 1, which means that by adding mid-small, if you're holding it on for a few years, you're not necessarily increasing the volatility of the portfolio. Last check that we do is also in terms of what is the liquidity support available, because earnings, valuation, these are fundamentals matter from a 1 to 3 year perspective, but in the short term, what matters is news, events, liquidity. So if there is shocking news coming in, we could see the markets correcting. But at the same point of time, if there is enough liquidity support, which is there would be some kind of a cushion which would be there to these markets. And we wanted to check how much money goes into each of these segments, for which we first check who are the key players in the market today. And like you can see in the above table, mutual funds are key participants when it comes to investing in equities. Within mutual funds also, a larger portion of the money comes from SIPs rather than lump sum. So as we speak, we have 29,000 crores plus SIP money coming in every month. We saw as an average of the last 6 months, where has that SIP money gone? And like you see in the second table, approximately 44% of it goes into large cap, 27, 29% gets into mid and small respectively. In absolute value terms, approximately 6,000 crores each enters into mid and small, which is a decent number. And it gives you a comfort that there would be some regular inflow which would keep providing some stability to the market. Last check that I do from a liquidity standpoint is to see tomorrow if there is a huge influx of money coming into these segments, would fund managers find enough opportunities to deploy? At the same time, if they have, let's say, a redemption rush coming in, would they be able to exit 50,000, 1 lakh crore at a fair price without compromising on the valuation at which they are exiting? And this helps us understand that if you see, as an example, the mid-cap 150 companies, the total free float there is 31 lakh crore. All funds, the 921 funds put together, they've invested 8 lakh crores of this. So roughly 27% of the ownership is held with with all these fund managers, which is not much. So if tomorrow 50,000 crore comes in, they still have, clearly 23 lakh crores available there to deploy. If they have to redeem, they'll find enough buyers in the market. So looking at all these four factors, we arrived at the decision of maintaining the large cap allocation. A weighted average earnings comes in at 16%, which when I compare to Nifty 50 is 8% above that. And the risk level is closer to 1 beta, which means similar risk levels of Nifty. So this gave us the comfort that your market cap allocation decision could be a key contributor to that 3 to 4% outperformance number, which we are targeting. And we went ahead with this mix. The next source is category selection and scheme selection. So now here, if you look at the entire universe that's available to us, we have 921 schemes. Like I said, we eliminated 4 categories. So if you eliminate those index, ETF, ELSs, international funds, sector funds, you come down to 410 schemes. On these 410 schemes, there are certain basic hygiene filters, as we call them, on the size, track record. That got us down to 223. We do a quantitative check on these 223 schemes. It brought us down to 45. Due diligence, qualitative assessment, as you may call it, brought us down to the final 14. I'll take you all through each of these in detail in the next few slides. Like category selection. Now, what do we do here is we check for 2 things. One, what percentage of schemes in a particular category have historically outperformed Nifty? So you want to be in categories where the possibility of having an outperformer is on the higher side. Second, you see what's the extent of outperformance that the funds have delivered. Like if I want a 55% large cap, for example, the large cap heavy categories here would be large cap, flexi cap, dividend yield. But if you compare the 3, you see within large cap, only 48% of the funds have beaten Nifty. In flexi, that's 50. In dividend yield, that's 55. Dividend yield is also a new category. They have less number of schemes, but between large and flexi can also have 70-75% underlying large cap exposure. But the chance of having an outperforming fund goes up here as per the historical data. And the extent of outperformance it's had is also more than that of large. So this is how, it helps us choose how many funds do you want to have in each category. We do one round of checks saying that, if you had invested in all the funds just as an average, good, bad, ugly, all put together, what the outcome historically would have been, which is what we've put in the next slide. The average of, underperformers, outperformers has been 2%. But with the methodology in place, with you taking a specific call on how much of large, mid, small we want in the portfolio, the outperforming funds have historically had an average 9% outperformance. So, this again supports that. Are we moving in that right direction of getting a 3-4% outperformance with the mix we've chosen so far? The answer to that came out as yes for us at this stage. So we went ahead with these final categories and moved on to the fund selection. Of course, when we eliminated those categories, we came down to 410 schemes. Now we do 4 checks here. First is the fund house should have at least 3,000 crores of equity AUM, because below that, we've seen those AMCs are mostly takeover targets. The fund management team is very small. Scheme stability. We don't look at schemes which have less than 1,000 crores of AUM. We look for schemes which have a 3-year track record. Fourth, we look for schemes which are domestic invested. So if you have more than 20% international exposure, we've eliminated those clearly because we do a lot of computation in terms of what the future potential of the companies are looking like. And as on date, we don't have the expertise to research on international markets. So we eliminated those set of companies as well. Came down to around 223 companies. So I'm going to take another 5-10 minutes, explain the process, and then we can open it up for any questions that the team may have. Now, when we rank funds on the quantitative side, there are 5 factors or parameters on which we rank. The first one is what we call as statistical parameters. Here again, within statistical parameters, there are 10 ratios which we look at. The whole idea is to pick funds which can do well going forward. That's the endeavor. But predicting a fund's future is not easy, and it's pretty challenging. So we try and incorporate certain statistics which can help us, increase the predictive capability, as I may put it. So which is where what we do is, there are certain common ways of looking at funds. So people look at past returns of fund, the Sharpe ratio of fund, standard deviation, and arrive at their decision on this is the fund to invest in. But just like I mentioned 3-4 ratios, there are 101 statistical ratios out there in market. Out of those 110, which one should we take? Which is where regression analysis comes in picture for us, where we go back into history from 2005 and we see what has been the correlation between that variable and the next year's return of the scheme. So let's say I'm sitting in 2006 and I see which are the funds which rank the best in terms of Sharpe ratio. What happened to the returns of those funds in 2007? Did they also have the best returns in 2007? Or they did not have? So what was the relation between how the Sharpe ratio is moving and how the return is moving? Likewise, we'll do it for, let's say, Trenor ratio. How the Trenor ratio has moved for schemes in 2006, how the returns have moved in 2007. If we do it for each blocks, so 6 parameter, 7 return, 7 parameter, 2008 return, 2008 parameter, 2009 return, like that we do for almost 20 years now. And then wherever there is a strong correlation between that variable and the next 1-year return, we pick those 10 ratios. Some of them are risk ratios, some of them are risk adjusted return ratios, like you will see in the next slide. We've put them, what those ratios are. As so value at risk, covariance. Anyone who wants to understand can easily Google it or can discuss it in the Q&A. But these are mostly risk and return ratios. This is, like I said, just one part. The second parameter we look at is what we call as target NAV. Now, we've been following this ranking process for the last few years. The variables were same even last year. Target NAV is nothing but where we try and compute what the next 1-year return potential of the scheme could be by looking at what are the target prices of the underlying companies where the fund has invested. We take these target prices from analysts who are generally top rated by Bloomberg. We have our own Insti team and they have a good coverage on mid and small. So we take their inputs as well here. The idea is to be in a fund which shows a higher potential going forward. Third thing we check is what is the active component of the portfolio. So what portion of the portfolio the fund manager is deviating from the benchmark. The idea is the more you go out of the benchmark, if you've gone right with your selection, you would, see a higher outperformance to benchmark. Next check that we do is whatever active calls you've taken as a fund manager, how much of extra return did it deliver? Extra return is not to any other benchmark, but to your own static portfolio. Let's say I'm a fund manager, I would see what was my October 24 portfolio if I had maintained that static throughout the year. What would be my last 1 year return? And let's say it works out as a 10% return. But as a fund manager, I'm not going to keep a static portfolio for a year. I would make changes, maybe some sector changes, some stock calls. If that portfolio where I have taken active calls delivers 13% return. So 3% extra came because of those active calls. We measure this for funds for 3 independent years to see what and how is the stock picking capability of the fund manager. Last, we're trying to see if there is any possibility of a mean reversion in a fund, which means if a fund has had phenomenal return the previous year, can it continue to have good returns this year as well? And we do this check by looking at the underlying portfolio. Let's say a fund had a phenomenal return and he has 20 stocks in the portfolio. If the fund manager continues to hold the same 20 stocks, there is a chance that they may not deliver this year because a high probability if a stock has run up the previous year may not continue to run up with the same extent this year too. But let's say you churn 80% of your portfolio. Now you're relying on new set of stocks for you to deliver. In this case, in spite of a good run last year at a fund level, I would expect you to have a good run this year as well because the underlying basket has changed for you. So that's, the fifth measure. We rank funds on all 5 of these, and we generally go with funds which would be in the top 25% on all or most of these variables. And that's how we come down to 45 schemes from 223, which is roughly a ratio of 25% coming in into a shortlist. So far, everything that we do is completely data and quant driven. There's no intervention over here till date. So the fund on its own merit has to come in the top 45. From these 45, when we are coming down to the final 14, we do a qualitative check. For us, the qualitative check is done at 2 levels. One where me and the team goes and interacts with the fund management team. Second, our joint CEO will separately interact with the CIO to further validate our questions, concerns, and then we discuss it out with an entire investment committee. So we have an investment committee which includes our CEO, joint CEO, economist, and most of the times, 80% plus times, our CEO, joint CEO are a part of that decision-making process. We meet almost once or twice a week when we are doing the ranking, and even otherwise, once in a week is where we catch up to give an update on the model portfolio. This interaction helps us, understand if there are any concerns the fund manager may be having. Like I'm not giving specific examples, but we've had a situation where the fund manager highlighted where size was becoming an issue, and we were noticing the cash allocation going up. The fund not being able to maintain the same style as it's been maintaining because of size constraints. A fund manager's conviction on where a fund has not done well, but he said, these are 1-2 stocks which did not play out. I have a size advantage with 5,000 crore scheme AUM. So the fund rebound can be much faster. I had another fund experience where the fund manager said, I know the fund performance has not been good. It may take me another 5-6 months to revive the fund the way we expect it to be. So these decisions help us. These discussions basically help us in arriving at the final decision from 45 to 14. At times, you have 2 funds of the same fund manager. So where the fund manager's conviction is more, you would want to have that fund. And that's how the final 14 was arrived at. From last year to this year, like you would see, there are 2 changes which we've highlighted in blue. there's an inclusion of Bandhan Large and Mid and Invesco Focus. That's 14% weightage. What goes out is Quant Multi and SBI Contra. For the new basket constructed, we do a final check that what is the weighted average earnings growth looking like for this basket. Earlier, we did it at the index level. Now we're doing it for the finally constructed portfolio. That's showing 23.6% against 8% of Nifty. That's 15% high. These are estimates. We all know that when analysts gets estimate, they do get revised, but this gives us the confidence that if it's showing around 15-16% here and what we are targeting is 3-4%, a high probability that that should be achievable at, again, risk levels being lower than a 1 beta, in spite of having a 45 mid small allocation. So risk is being managed. The return potential remains for the basket, and we are getting the desired market cap that we want. So that's how the portfolio got constructed after the entire step and the entire process taking us around 3 months or to complete. Like I said, this portfolio is likely to continue for the next 12-15 months, unless there's a mid-year change required, which we will highlight to the team if there's a need for that. But if not, then we'll have this basket continuing till December 26. I'll stop here. Take any questions that the team may have.
Thanks, Shweta. If you want to break off 5 minutes because you've been speaking continuously for the last half an hour, if you want.
No problem. We can take up the questions. They're good.
Take up the question. Okay. So the first question is Shweta on. So there are actually multiple questions in this. I'll just try to club. So Invesco focused, which is now included. I think so. The last 1 year performance is not something which is great. So why it has been added? That is one. And why Motilal Large and Mid has not been added. That's the second one. I'll just break it in parts so that it's easier that we can answer all. So that's the first two questions, that Invesco focus, which has been added. I think so last 1 year performance has not been that great. That's what the question is. And why Motilal Large and Mid has not been added.
Perfect. So, addressing those questions, I think, first of all, if I, talk about the entire selection process here, you would basically see that return is one variable in that statistical parameters, but most of the variables that we have are forward-looking or checking how the fund manager's stock picking capability has been. To that extent, if you see, clearly Invesco focused cleared most of the filters for us and it got shortlisted. Even when we did a qualitative check, I guess, on the fund, AUM reasonable. One few things that we check, and I want to highlight here, when we do a quality is to see if the fund has been seeing a redemption pressure, if there is a change in the fund manager recently, if there has, how the liquidity profile of the fund is, how the ownership of the fund is, and then other aspects of the fund house, fund management style, conviction of fund managers, all of that is being noticed. And honestly, this is, we do the return check too over here. And in June, when we did this, there are in the focus category 28 funds. The fund in 2024-25 financial year came in third ranked in the first quarter FY20, the current financial year, because that's when we were looking, that was a cutoff point till I think July. The fund was 5th ranked. So I would not say the fund has had a bad performance. I'm not too sure. But like I said, that's not the only data also that we look at. So clearly it cut the mark for us. Motilal Large and Mid, as far as this fund is concerned, I believe Motilal Large and Mid was there for us in the shortlist of 45 schemes that we had. But there were outflows in the scheme. We were seeing some amount of an outflow. there was the fund management teams not being as stable. So clearly within the large and mid cap category, and Bandhan large and mid scored way over the Motilal scheme for us.
Cool. Shweta, the next questions is of course on Quant Large SBI Infra. I think so. We had discussed this. We had come out a note also 3 months ago, but this question continues to be there that Quant Large and SBI Infra have been the funds which have not performed up to the mark. Of course, it's been the underperformers, which you mentioned in the start that there would be underperformers, but still the client keeps on asking, I think so, these questions that these two schemes are not doing great. So why they
So
continue?
no, sure, perfect. And so I think we've also had a debate on the schemes because we do understand that आप कितना भी बोल दें, that look at it at the basket level, those scheme level questions at times do crop up. So, but both of these, let me first address maybe the easier one, which is a Quant Large. The fund did go through its down cycle. A majority of the down cycle, I would say, came in the last financial year. If you look at how the performance of the fund has been in the last 6 months, which is mainly going to be this financial year, because we're talking about what October end right now. So yeah, between April till now, the fund in 35 funds has jumped up to become the best fund. So there is a recovery which was expected to played out, and that's where it does not make sense to exit now from the scheme. Any investor who's come in the last year would have seen the down cycle in the first 6 months, seen a revival in the last, in the recent 6 months into the fund. So I guess, you should know when you have to exit. Exiting now is a wrong exit call to our mind. So 6-7 months is showing the change in the rank from, if I see 1 year basis, it's yet to catch up. But with the way it's picking up, I think, clearly where your category average for this 6 month period tends to be, it's like I said, it's the best in the last 6 months. So there is an improvement taking place. Even in case of SBI Infra C, when we break it up and we review the schemes, we saw one, we see since when the underperformance is happening, why is it happening? Is there chance of revival there? Last year, a lot of the underperformance came in because of the Reliance allocation, the cash allocation, which had started to rebound. April, May, June, the fund was doing fine. It was on that recovery mode. July, it was hit with the one IEX allocation which it had, and the stock corrected by 40%. But even now, if you see, the fund is sitting, like I said, at 24% earnings potential, which is way higher than that of Nifty 50. The fund is receiving continuous inflows, and that's helping the fund manager to, very smoothly, very flexibly make changes that he wants to make. It's a 5,000 crore fund, sweet spot for the fund manager, and the conviction of the fund manager, the CIO, to revive the fund. That's where we've held on to SBI Infra as well. And don't go with the name. I keep saying, everyone, don't think it's an sector fund. It's not a sector fund. It is, I would say, stocks which are pure plays infra in that fund would be 30-35%, not more than that. And it's not that infra is not doing. The government is, allocating whatever capex it had mentioned in the budget. That's happening. It has companies like Reliance. Reliance is not something, it's a conglomerate. You won't call it as infra. 14-15% banks, you won't call that as infra. So that's where the majority of the portfolio is. So it's a well diversified portfolio with chances of recovery according to us.
Absolutely. So there is one question which is always there, Shweta, which is Parak Parikh Flexi Cap. So I think for the last 1 year, the performance has been good. So why doesn't it? It's part of our portfolio. It doesn't come under our selection process.
It is a part of that 223 fund universe that we get. It does not, this year also, it did not clear the ranking. It didn't even come in that 45 fund shortlist. And honestly, if you see, for us, we've had one flexi cap fund between HDFC Flexi that we have and Parag Parikh. Actually, HDFC Flexi Cap from the time we've included is done better than Parag Parikh. So I don't know where the question comes in from. Of course, there could be certain pockets where Parag Parikh did better. But if I look at it, it's 21, 22. Precisely, I would say, 2021 is when we had included uh, the HDFC Flexi in our portfolio. And from there to now, if I am looking at the performance between the two schemes, HDFC is scoring better. So we've not missed out by not having Parag Parikh in the portfolio.
Absolutely. There is one more question on most of the Motilal funds have been in the top quartile for the last 2 years. So why they were not in the final list of portfolio or the schemes in the 14 schemes? We don't have any Motilal Oswal funds. So any specific
We
reason?
No specific reason. They didn't clear the mark. So like I said, we have few schemes. I think, spoke about the large and the mid cap fund of Motilal. We also had a Motilal mid cap that came in the shortlist of 45 schemes. But if I look at the data there, while Nikit has been managing it, it's been having outflows in the portfolio. The exposure of Nikit managing it is also on the higher side. There's more concentration in terms of how they are holding it. So in 25% of the portfolio, they own more than 5% of the free float of those companies. So, there are liquidity concerns. If you see, there are so those are some of the checks that we do. It would take almost 15 days for them to liquidate the entire portfolio if they have to liquidate it. So yeah, when we do a qualitative check, also a lot of these factors are looked at.
Any specific reason why SBI Contra has been exited, Shweta? Because the fund has been doing fairly well.
So the fund has been doing well, but like I said, I think that was the example I was actually giving. 47,000 crores. The fund has been sitting on cash. There were concerns where the fund manager himself highlighted that, I'm not too sure of the fund given the size, uh, and I'm not getting an opportunity to deploy if I have to be a pure play contra fund manager. So we said maybe it's time to book our profits because we've had the fund. We've seen the entire journey from 5,000 to 47,000 crores of the scheme.
Absolutely. What would be the total number of unique stocks in the portfolio, Shweta?
Closer to 430.
430. Okay. How much time? I think so you've answered this, but how much time normally you take to change the fund which is not performing since election? Like say we've added
8 to 9 months is what we give them.
Okay. There's one more question on, can you please confirm what is the ranking for SBI Contra and Quant Multi within the 45 shortlisted funds? So
It'll be different for each category.
yeah,
So
it would be
each
different
line.
for each category. But were they part of the 45 shortlisted?
Yes.
They were there. After, I think so that you've answered. Specific reason for Quant Multi to go out, Shweta? SBI Contra, I think so you answered, but
Quant multi-year, the fund manager said, it may take 6, 7 months for a May to revive the fund from where it is or where it has been prior to June last year. So we had given it the 8, 9 months period, which we generally give. If you're not seeing a revival and it's going to take further 6 months, I may be better off being in something else and recover faster.
absolutely. Quant Multi is somewhere where we had 1 year of good returns and then 1 year of.
Yes. We had 15 months of good return and 9 months of bad return in the fund.
Absolutely. I think so. These questions. Shweta, 2, 3 questions are there that why we have 14 schemes and why not a smaller portfolio of say 7, 8 schemes. It's like if you could just.
So earlier on, I think we also
Highlight
had
it
the
again.
same conviction of having 7 to 8 schemes, but we also do a lot of audits on client portfolios. So there could be clients who have mutual funds with us, clients who do mutual funds with some other broker on their own through the direct code. and we do an audit. So we look at every transaction of theirs, and we see if that transaction, every transaction done, if they had done with the Anand Rathi model portfolio, what the return would be, and we do this comparison. 88% of them, and we've done more than 8,000 client audits. We have checked 55 lakh different transactions across some 156 odd different distributors. We've been doing this for 3 years now. 88% of them underperformed an AR model portfolio. So somewhere this also tells us that the selection process is running and working better than most cases. But wherever we've had the rest of the 11, 12%, which they did better, that in a way comes into research for us and see how we can improvise. So one observation we've had on those portfolios that did better than us was they had on an average 26 schemes in the portfolio, which is where our belief changed that, if you have 14, 15, 16 schemes, it's not too many schemes. And we went up from 8 to 14. Otherwise, we were of the same, school that adding more schemes could mean compromise on returns.
Shweta, one question is on, does the current portfolio have any global exposure, or is there investments in any international stocks? And if not, should we have a greater allocation in those stocks, or look at schemes which might have some allocation there?
So today, the allocation to international stocks would be less than 2% on the overall basis, because most of the schemes are 100% domestic schemes. Our view also is that Indian equities could do better than global, which is where we create a 100% domestic equity basket. Third, as on date, we don't have international expertise. So we would, refrain from creating an international basket.
Any thoughts on SIF, Shweta, which has been launched?
It's too early. In our experience, see what SIF does is it's better than a PMS or AIF because it starts at a minimum 10 lakhs. It's going to be a little more regulated because it's going to be under the SEBI purview and under the mutual fund purview. So whatever they've listed down, it's going to be better in terms of transparency, cost, all of that. The difference that it can bring in is it's a combination of, you can do a lot of derivatives there. So from a long only equity portfolio, you can do a combination of, the long short strategies and so on and so forth. For Anand Rathi clients, it may not be bringing in something very different because we do a combination of mutual fund and structures. So we're doing equities and we're doing derivatives as well. Plus, as of today, I would not say that there are many AMCs which have that derivative expertise with themselves. So a lot of these AMCs are right now in that phase where they're building their backend teams, hiring is going on. On the other hand, they're also getting the license, to do an SIF. I would wait and watch, or we will not jump into an SIF right now, because our portfolios would have the derivative exposure. So we may not be getting something very different than what we are doing. Plus, both the things that we do, whether it's MF or derivatives, we have our expertise today. We are among the market leaders there. Like even when it comes to mutual funds in the non-bank B2C category, we are the largest. Derivative book, we have the largest market share. So, we would wait, let some come, let's look at the track record and then invest.
Any views on gold and silver, Shweta, because they've moved significantly over the last 1 year?
Gold can be a replacement to debt, not to equity. Likewise for silver, silver has been more volatile than gold because if you look at it, silver is still an asset which will depend on the industrial demand. Right now, the EV space is pretty much doing well. So the requirement for silver from an industrial usage perspective has also gone up, and people have alternatively, instead of gold, start looking at silver. But we did this one study. I'll try and pull out the data if I get. If you are a 8, 9, 10-year investor and we're looking at, gold data of how it's done from 2005, 2001 onwards, the probability of equity delivering more than 10% is way, way higher than gold delivering more than 10%. So if you're a long-term investor, be in equity. If you are someone who has huge debt and you want to shift that debt, uh, debt can go into gold, equity allocation cannot go into gold. I would say if somebody has a 10-year horizon, you can be 100% into equity, or have a combination of equity and structure that we do. Structure also do better than gold. From a risk perspective, it would meet all those demands.
Absolutely. Shweta, two more questions are there on what are the thoughts on DSP Mid and HDFC Flexi being retained? It's like they means they qualified on all the parameters, or what worked in their favor that they continue to be with there?
DSP and HDFC is, both, yes, meets the requirement that we have. I know where the question's coming from, because DSP is also one scheme which the recent performance has not been good. But he's also a fund manager. Rohit is also a fund manager where he himself doesn't like underperformance. So he, goes back to seeing how the fund can be revived as soon as possible. So he would be amongst those fund managers where if there's an underperformance within 6-7 months, he would rebound on its own. And every fund will go through its cycle. DSP last year, if I look at it, was also the fund which had the best, return. So HDFC Flexi is doing pretty okay. See, if you feel that shifting from one fund to another fund will only add a little bit differential, then you don't want to pay and tax cost and move out, unnecessarily.
Absolutely. Shweta, just one question was there that say 60-70% of the schemes that perform very well in a particular year generally underperform over the next, say, 1 year, 2 year, or 3 years. Is that true statistically? Any data point which we've seen on this?
Statistically, the mean reversion data shows that if a fund has been in the top quartile last 6 months, 1 year, then there is a 25% chance that it will continue to do well and be in the top quartile in the next 6 months, 1 year. So mean reversion does play out and it works even on the bottom quartile. A scheme which has been in the bottom quartile, there's almost a 70% chance that it will move in the upper quartiles. We had done the study from 2013 till 23, I think, for that tenor.
Partners, if there are any more questions, you can post it on the group. I think so I've covered most on this. Few, I think so Shweta had already answered, so I hadn't taken them. So on the fee structure, currently, I think so it is just a consultation paper. So let I think so the final verdict come out, and then probably we can discuss this, because currently it would be too premature to discuss anything on that. SIF, I think so Shweta already answered. Performance is there in the performance from April till date is already there in the presentation. So we'll share the presentation with everyone. What we are going to do with these two schemes. So Shweta, if you have time, I'll just cover the operation bit, and I think so it will take another 5 minutes. And if there are more questions, we can take that. Otherwise, close. So just let me.
Sure.
So basically, partners, how this change is going to be implemented. So we'll be sharing this note with all the clients as well as the partners today. This note and the selection process both will be shared with the clients. In this note, so the FAQ note is basically just covering in short what the new selection process is. Of course, the detail is also there, but this is a short presentation which we've created of just giving a gist of how the new selection process is, what is the new selection process, and how we've arrived at the two changes which are there. So I'll not cover this. This is basically will give you a snapshot that two schemes, which is Quant Multi and SBI Contra, is something which have moved out. Bandhan Large and Invesco Focused have been added. The weightage of all the rest of the 12 schemes is the same. There's no change in the weightage. only two schemes which have moved out. So 7% each was the weightage in Quant Multi and SBI Contra. The same weightage has been added in Bandhan Large and Mid and Invesco Focused. So the changes are very less. The market cap allocation, as Shweta mentioned, is the same as last year, and the risk is almost equivalent to Nifty. Now, how this change is going to be there? So first thing is the SIP. Now, currently, so what we would do is we would be mailing to all the clients tomorrow. The clients who have the SIP going in the 14 scheme model portfolio, that's the Wealth Plus Wealth portfolio which we have. All those clients whose SIP is going in the 14 schemes, we would be mailing them about the new allocation. It would be a negative confirmation email that if the client wants to continue his investments in the old allocation, that is in Quant Multi and SBI Contra, then the client will have to revert to it. If the client doesn't revert, then from 7th November onwards, whatever SIPs which are going to hit from 7th November onwards, that would go as per the new model portfolio, which is including Bandhan and Invesco. So if say in some cases, if the partner has done or given only say 3, 4, 5 schemes, we would probably not mail them, but rest who have the allocation in the 14 scheme model portfolio, those would be mailed. And the clients who've signed up for the SIP over the last 1 month, when we've kept the two schemes which we gave an exit in September, post that, whatever clients have added an SIP, because their SIP would be going only in 12 schemes, there, of course, the communication would go. So that is on the SIP. The communication would go tomorrow. The client doesn't need to reply to it. It would be a negative confirmation that if the client doesn't reply, it would go in the new model portfolio. If the client wants to stay invested in the old model portfolio, then probably he'll have to reply to that. So that's on the SIP part. If there are any existing STPs going from the liquid schemes or the arbitrage schemes to the model portfolio, their partners will have to connect with the client, because the debt portfolio, the liquid schemes or the arbitrage schemes will have to be exited, and you'll have to invest again as per the new allocation. So this is something which we can't do it through the system. So I would suggest that you please speak to the client, explain him that this is how the process is. This is how we will be redeeming. The money will go back to the client's account. You take it back, allocate as per the new model portfolio weights, and then the STP would continue. So in the existing, so this note would go, of course, go to clients also. So in the STP, you'll have to get in touch with the client. Tax implications. So the LTST report is already there, in which you will get all the details of which schemes units are long term and which are short term. For Quant Multi and SBI Contra, we are recommending only once you completed 1 year. That is the time when you exit. So once your 1 year holding period is completed, you can exit the scheme. It will come in your LTST, and of course, it will come even in when you put the sell recommendation, you put the redemption order in the app or the portal. Of course, the taxation is that if it is short term, it is 20%, the long term, it is 12.5%. There will be no exit load, because we are not recommending the clients to take exit load and move out of the scheme. So once it completes 1 year, then only we will move out the scheme. As I said, so the rebalancing, the change which is there, so their partners, you'll have to speak to the clients, because now, as we all know, it's like since post 2022, where the pool account was closed, so the money goes back to the client's account. So then we need to discuss with the client, actually explain him the entire process, that, sir, once we put the redemption, you will get the monies in T+2 days. You arrange for a check pickup, or the client can do an RTGS in the mutual fund account, and then the investment will happen. So it's a proper 2 days process, where he puts the redemption, say, on Wednesday, and Friday the client gets money. Approximately by 12 o'clock, the client gets the money. If he can transfer the funds, we can send him a purchase consent, and the transaction will happen. So kindly discuss the process with the client before executing, that, sir, this is how the process is going to be. That will ensure that you get the monies back. Otherwise, if you don't discuss it and then the client says, no, I am not available right now, so then it might just delay the process, and that might lead to leakages, which we don't want. So kindly discuss the process of how this change is going to happen, because of course SEBI has done this, so we can't do anything on this. The money will have to go to the client's account, but this is how the change has to be executed. Of course, non-platform equity investments is something which can be done through the OTP also. What will happen if the client has invested, say, over the last month, 1 month, 2 months, 3 months ago? There's nothing to worry as such. These two new schemes which have come in. So any investment which the client does over the next 1 year, more monies will be allocated to these two schemes based on the weightage. So it is not that he's going to lose out on anything. Any new monies, the system is already built in place that the new monies would go in this two schemes so that we can maintain the allocation for the client in these two schemes as well. It is not that 12 schemes are the same, the weightage is also same. So this time I think so the changes are very minimal. And once the old schemes complete 1 year, we can tell him to realign and move to the new model portfolio. What will happen? So the new investments since 20th October is when the new model portfolio was as it is introduced on the portal. On the tax portfolio, we've made no changes as it is with the new regime benefit, which is there from this financial year of 12 lakhs. I think so very hardly few clients would be there. And even if there are clients who are actually doing this, you can just tell him to speak to his CA, what is his income, and tell him to move to the new regime. I think so there are much more benefits there and he'll save more tax. So the ELSS portfolio is something which you can definitely go back to your client and actually have that discussion with him. That will also add more value to him, that unnecessary doesn't block his money for 3 years. So that's there. And we've also added the performance of the schemes which we've given an exit since the start. So out of all the schemes which we've given an exit, we have a 65% hit ratio. It's like post our exit, how the scheme has done vis-a-vis our model portfolio. So out of all the decisions, 65% of the times we've done better than the schemes which we've exited. So that is also something. So this slide is something which we've added so that it gives more confidence and conviction to the client that why we are doing this. I know it's a process and we don't just want to do it just for the sake of it. Of course, there are tax implications, there are cost implications when we do this, but it's a necessary process and you have to keep on monitoring your portfolio every year. Then only you will be stay on track for the 14-15% which Shweta mentioned. That's the objective. So you need to make these changes. This data point will again help you when you discuss with the clients that how our past changes have done. So it is not that we've been doing this recently, we've been doing this since the start, and that's how the performance has been. So this note is something which partners will be mailing to all the clients today. Post our call, it would be mailed to you as well and to all your clients. The SIP communication will go tomorrow, and 7th onwards, effective 7th onwards, SIP would go in the new model portfolio. So any client who's having an SIP, say on 1st of 2nd, it would still go in the old schemes because it's a process. We just can't change it. It's a 3-4 day process. We need 3 working days. That then only the change can be implemented. So that's the reason we've taken 7, because we'll be mailing tomorrow. We'll give a day or two to the client also to respond. And then post that, we would make these changes. These notes would be available on the portal as well. So you can access that. With that, I'll just check if there are any more questions and then probably we can close. So no change suggested in the arbitrage fund also. So debt fund, we are recommending the arbitrage fund, which is Kotak and SBI. So we continue to maintain the same recommendation. There are no changes there. Of course, there is tax benefit, which is there in the arbitrage fund. So then it continues to be a much better option compared to debt funds. For the short term, it's like the ultra short term. We have one scheme, which is Aditya Birla Money Manager. You can continue to invest there. I think so. If there is an ultra short portfolio which is there which the client wants to invest in. We would also some portion of portfolio and hybrid. So Shweta, this is one question. If you can just add more color there, is that some portion of the portfolio, should it be in hybrid or balanced funds?
Not really required because see, if you are someone, you have a client who's not doing asset allocation at a balance sheet level, then hybrid, I would say, if he doesn't have an advisor, nobody to tell him what to do, then going in for hybrid makes sense for the entire portion of the money. But if you are advising your client and he knows how much of equity debt allocation is needed, then separately managing it would make more sense than putting a portion of it in hybrid. That's how our experience has been, because even in hybrids, I mean, we had some time back done a comparison of 65-35, our strategy with balance advantage funds and most of those. It shows that, this doing a 65-35 may be a better option. So that's where I would say no hybrid if you are doing asset allocation for your client. If the client is not taking asset allocation decision from you, then hybrid works, because at least the fund manager is doing it on your behalf.
Yes. So we have a retirement plan. So client who is retired, they want liquidity withdrawal, month-on-month increment, year-on-year. So we have a retirement plan in place. I don't know your name. You've not mentioned it. So we have a retirement plan. You can connect with your business development manager. He'll be able to guide you on what that plan is and how we can actually help the client in his retirement by increasing his monthly withdrawals also year-on-year. So a plan is already there in place. So that is something which you can use to show it to your client. It will give him a perspective of how his funds flow would be. So it's a separate topic, so I would not touch more on this, but we already have a retirement plan in place, which is covering the current mutual fund portfolio and the structure product. So based on these three things only, we can actually create this retirement plan for the clients as well. There are no further questions. So thank you, Shweta, for doing this call. It was a wonderful call. A lot of knowledge is something which we have gained, and we can actually say that what all efforts which have gone in basically to create the model portfolio. So it is not that even if the changes are very less this time, but you've been through the same selection process of doing it zero based, that if I want to select the funds, how do we do it? So I think so that full 3 months process is there, and you keep on continuing to do it. You'll keep a track on it, and the next change will mostly happen in the month of December 26. So thank you, Shweta, for actually taking us through this. Thank you, partners, for patiently listening to this. Email communication and everything would go, and I would urge all the partners to actually start speak to your clients over the next, say, next 2-3 months is something where we should target to actually get done the restructuring for all our clients, so that when the new model portfolio comes in next year, we will have clients who can realign immediately at that moment. That is the logic. That's why we've moved to 15 months instead of 12 months. So and the team would of course be there to help you. The BDMs would be there, the ops team would be there to help you out in carrying this process. So thank you for patiently listening, and thanks, Shweta, for doing this call. Have a great
Thank you
evening.
so much. Thanks, everyone. Bye bye.